Today, we're jumping into a really high-stakes moment in the tech sector, right? At that volatile intersection of high-performance computing and, well, digital infrastructure. We're focusing today on one company, IREN Ltd. That's ticker IREN on the NASDAQ queue. And our whole deep dive is based on this one. Very specific, and I have to say, very contrarian analysis report.
It is. The title is Iron Investment Strategy, Capitalizing on the Bullish Dip.
Right.
And that gives us a really clear mission today. We're here to unpack a strongly bullish argument. The analysts behind this are basically saying that the stock's recent 4% drop isn't a red flag.
Not a reason to panic.
Exactly. They're framing it as a golden buying opportunity. So we need to dig in and see, what data are they actually using to back up such a confident claim.
Okay, let's nail down the facts for you. IREN closed yesterday at $40.30. And just to show you that volatility, it actually dipped another 0.40% after hours.
And this report argues that red day is just a classic trap.
A trap.
Yeah, a trap to shake out retail investors while creating a discount for what they call, smart money.
Okay, let's unpack that. If we're going to accept that premise that this is an opportunity, we have to start where the report does.
Yeah.
With this fundamental market disconnect, the central question they ask is, how can a company with revenue growth at an explosive 160% be trading at a PE ratio of only 23?
And that gap is everything to their argument. I mean, think about it. A PE of 23. That's what you might see for a stable, mature company, maybe growing in the single digits.
Industrial or something.
Exactly. But IREN is growing at 160%. The report basically says the market is selling you a high-performance sports car, but pricing it like a used sedan.
Okay.
That specific comparison, the 160% growth versus the 23 PE, that's the single biggest piece of evidence for their whole golden opportunity thesis.
I hear you, but let's pause on that. A low PE can also be a sign of market distrust.
Of course.
Investors might be looking at that 160% growth and thinking it's just not sustainable. Maybe it's too tied to crypto volatility. What does the report say to counter that skepticism?
That's the million-dollar question, isn't it? And the report tackles it head-on. They argue the low PE is simply a lag in market perception.
The lag.
Yeah. The dip yesterday is the market noise, an overreaction. But the massive financial performance, the numbers we're about to get into, that's the signal. And the signal, according to them, is being misread because the market is stuck looking in the rearview mirror.
So the argument is that sentiment just hasn't caught up to the business reality.
That's it in a nutshell.
Okay, then let's shift to that reality. Let's look at the hard financial proof the report uses to say this stock is undervalued. It all starts with those growth metrics.
And they are pretty hard to argue with.
The report lays out specific figures. Revenue growth is up approximately 160% year over year, an incredible rate of acceleration. And we're not talking about small numbers here.
No, this isn't a tiny startup. The report confirms IREN's annual revenue has hit $501 million.
$500 million. That scale makes the growth rate really significant.
And crucially, this is what separates IREN from a lot of other high-growth tech plays. They aren't just burning cash to get that scale.
Right.
The report points out they've hit significant sustained profitability, a net income of around $86.9 million. That shift, from growth at any cost to a profitable enterprise, that fundamentally changes the risk.
And that's why they think the PE of 23 is so irrational.
Exactly. Profitable high-growth companies just don't trade that cheaply very often.
That transition is powerful. But the analysis really zeroes in on operational quality, which I found fascinating. It goes beyond revenue and net income to their gross margin.
The profit they keep after the direct costs of their service.
And they cite that figure at an astonishing 68%.
68.
When you think about what a data center does, buying hardware using massive amounts of power, a 68% gross margin is, well, it's remarkable. The report calls it elite-level efficiency.
And just to put that 68% in perspective for you, that's a margin you usually see with pure software companies, SaaS businesses.
Right, where the marginal cost is almost zero.
Precisely. Data centers are capital intensive, so to achieve those margins, it suggests they have incredible pricing power and just superior cost management. It's a key piece of evidence showing the market is viewing them as a commodity when they have the financials of a high-end tech provider.
Okay, so that brings us to how the report actually defines IREN's business today.
Yes, and this is critical. The report is explicit. IREN is no longer just a Bitcoin miner, even if that's where they started. It's now a high-performance computing, or HPC, data center play.
And that pivot is the hinge for the whole golden opportunity argument.
It's everything.
Because that pivot taps into the biggest narrative in the market right now, AI. The analysis claims iron is powering the AI revolution, but they highlight one detail that they say elevates them.
The 100% renewable energy.
Exactly. And this isn't just a marketing point, it's a real business moat.
Yeah.
You have these big tech giants, the report mentions rumors about Microsoft and Oracle, who have huge ESG mandates.
They have to find clean power.
They must. So IREN's renewable infrastructure isn't a nice to have, it's a gatekeeper for potential billion-dollar contracts. It changes their status completely.
It does. It moves them from a commodity producer, which is what mining is, to a preferred enterprise partner. HPC and AI is a services business. It's built on stable, recurring contracts.
Not just crypto prices.
Right. The report is arguing the 160% growth is being driven by this enterprise pivot. So now let's do that valuation reality check the report lays out. If we accept the premise that IREN is an AI infrastructure company, then its PE of 23.35 is, well, it's a flashing light.
So what does that comparison group look like? What are their true peers trading at?
Well, if you look at the pure-play AI infrastructure companies cited in the analysis, they often trade at 50 to 100 times PE, sometimes even higher. Now compare IREN to its old group, the crypto miners. They're often unprofitable, so they have no PE. IREN is highly profitable with elite margins, but it's valued near the basement of its old category.
So what's the bottom line here?
The report concludes that the ridiculously low PE means the market is still applying that old crypto miner discount. It just hasn't priced in the more stable, more valuable HPC and AI business model. That misclassification is the opportunity.
That makes a lot of sense. So from there, the report transitions to what they call social proof. Basically, does Wall Street agree with them?
And they say yes.
They note the consensus among established Wall Street analysts is a unanimous strong buy. Why?
Which is pretty rare. That kind of consensus gives their thesis some important third-party validation. It suggests the story is really changing.
And they get into the specific price targets, which really quantifies the potential upside.
Right. And remember, the stock is currently trading around $40.30.
So what's the average target?
The average analyst target in the report is $66.71.
So that alone is a potential upside of what, 65%?
About that, yes. But what's really striking is the street high target. That's way up at $136.
136. That's a 230% upside.
If that optimistic view of the AI pivot proves correct, yes.
The key takeaway there is just undeniable. Even the conservative average target suggests the stock is trading at a huge discount to its expected earnings power.
Which naturally leads right into the technical analysis section of the report. It's all about timing the entry.
Hence the golden buying opportunity language.
Exactly. The technicals suggest the stock is just consolidating after a massive run-up to near $76. So this 4% drop is described as a healthy correction, a necessary pause.
And the analysis identifies concrete levels for investors to watch. The first is the support level, the floor. They put that between $38 and $40.
And the stock is currently at $40.30.
So it's sitting right on top of that support zone.
Right at the top. It's a psychological floor. It's where buyers who miss the rally tend to step in. So the technicals suggest immediate downside risk is limited.
And on the flip side, what about resistance? The breakout level.
That's set at $45.
45.
Reclaiming that level is the trigger. According to the analysis, clearing that breaks the short-term downtrend and opens up a path toward $50. It's a very clean setup.
And finally, they look at the long-term momentum, the 200-day moving average.
The gold standard for long-term trend. And it's firmly trending UP, sitting well below the current price at around $35.
Which just reinforces their long-term bullish case.
It does. In simple terms, this short-term dip is happening within a very healthy, established upward trend. It's not the start of a collapse.
So to summarize the entire argument from this analysis for you, the 4% drop that caused all this panic, the report says that's just market noise.
While the fundamental evidence, the 160% growth, the $500 million in revenue, the $87 million in profit, those elite 68% margins, that is the true signal.
The signal of a rapidly growing, high-quality company.
And the report's final verdict is that this combination of strong fundamentals with a technical pullback to support creates a classic buy-the-dip scenario, an opportunity for both swing traders and long-term believers.
It's a compelling case because it gives you this very specific data-driven perspective. It's rooted in both the financials and the technicals and tells a powerful story of a company that's undervalued because the market is just using the wrong lens.
And that's the core assumption we've unpacked. The entire golden buying opportunity hinges on the successful acceleration of this AI crypto supercycle,
Hmm.
which, it raises an important question for you to consider going forward. What would a breakdown of that supercycle narrative look like? I mean, what if global competition heats up and squeezes those elite level 68% margins? Or what if a big partner like Microsoft just decides to build its own clean energy data centers instead? How quickly would this analysis shift if those growth projections start to slow down?